Are we really buying $1 billion worth of properties each day in Australia? Well, the value of new home lending almost doubled since May last year. So, in today's Property Insider video, Dr. Andrew Wilson and I unpack the latest finance data showing how much money is moving into our property markets. We also look at the latest auction results, the rental report, and what's ahead for our property markets. If you want to keep up to date with what's happening in real estate, subscribe to our YouTube channel. And why not click the little bell icon so you can be kept up to date? Are we really buying $1 billion worth of property each day? Well, the value of new home lending almost doubled since May last year. The latest Australian Bureau of Statistics figures show that new home lending increased 4.9% in the month of May alone, and Aussies are borrowing a whopping $32.5 billion in new home finance each month. This means $1 billion of new money is moving into our property markets each day. And Australian investors are back with investor lending now at the highest level since June 2015. However, this investor surge comes at the cost of first home buyers, with the number of owner-occupier first home buyers dropping for the fourth month in a row. Of course, finance approvals are what we call a leading indicator. They're suggesting that our property markets are going to remain strong over the coming months. So in my Property Insider chat today with Australia's leading housing economist, Dr. Andrew Wilson, Chief Economist of My Housing Market, we look at what all this means for our property markets, as well as what's happening to our housing and our rental markets. Hi, Andrew.
Good morning, Michael. Some interesting home loan data is a window, as you said, into the market. And I think there were some interesting results actually over May, even though we are looking back a month or more. It is developing the trends, I think, that we expected, but perhaps some surprises as well.
Well, we'll get to look at that, but as always, let's start with the auction results. Especially interesting to see what's happened with Sydney having been in lockdown for a week and a bit now.
Yes, we did start to see two factors in our auction markets at the weekend, Michael. Firstly, we saw the usual impact of school holidays. Of course, July is a holiday month, the midwinter school holidays upon us in all of the capital cities. That does act to push down listing numbers, and typically listing numbers from the top end of the market that are more likely to be having and enjoying those midwinter holidays, perhaps not as much this year as previous years as a result of lockdown. But numbers did fall away in terms of the listings at the weekend. But again, we've set a new record. It's like every week we set a record for the number of auctions conducted on a July Saturday. And it's only the first weekend of July. And we've clearly broken the record for national listing numbers, the national capital city auction markets, and have driven, of course, by record numbers in Sydney and Melbourne. The reflection of school holidays in the sense that numbers were down from the previous weekend. And of course, the other factor that we have, which isn't a direct impact as yet, and that's the COVID shutdown in Sydney. We won't see that impact the market for a couple of weeks because, of course, listings are lagged in the auction markets. What we're seeing is decisions that were made 4 or 5 or 6 weeks ago. But the fact in the Sydney market that was interesting is we did see the lowest clearance rate of the year so far in Sydney. And the reason for that wasn't really the lower listings. It was, which you'd expect to have a higher clearance rate. It was a significantly higher level of withdrawals. And it was the withdrawals that dragged the clearance rate down. In fact, we had around 17% of our listings that were reported withdrawn. If we had the same withdrawal proportion as the week before, which was around 9%, we would have had another clearance rate well over 80%. So the withdrawal numbers in Sydney pulled the market down because it was the first full weekend really of lockdown. But what was interesting in terms of the withdrawals, Michael, is that it was only 17%. If we go back a year to the other lockdown periods, we saw a much higher proportion of the market was withdrawn when shutdown was enacted. And I think that's showing us that the market, that buyers, sellers and agents are all quite adapted to conducting transactions in a lockdown environment. We saw that last year. They're continuing to learn. And as I said, those withdrawals numbers, although pushing down, because withdrawals are counted as a listing in auction clearance rate methodology, dragged the clearance rate down, but certainly not at anywhere near the levels that we saw last year. And going forward, I think, again, that just reflects that shutdowns are just an annoyance in terms of their implication for the housing market, particularly over the shorter term, and that once our Sydney lockdown and Brisbane lockdowns are completed, then we'll be back up and running again with a full auction environment. But look, the big picture is, Michael, no sense of slowing down in this market. We are starting to see the implications from the typical July holiday period, the mid-winter holidays, fewer listings, but the market still is at record levels, notwithstanding that, and clearance rates below where they were at their peaks in March, but still very much a boom time market.
Well, buyers are still out there. Buyers are keen. They've got their finance in place too. And that's what the latest ABS statistics showed, which suggests that they're going to be a force moving forward. Home buyers and investors. In fact, the number of loans have increased a whopping 95.4% since May last year. And as I said, over $1 billion worth of money coming into our property markets every day if you even it out over the month. Owner-occupier lending went up, but first home buyers went down. You've dug into the figures, Andrew. What have you seen?
Well, we're not surprised about what's happening with first home buyer activity, Michael. The higher prices are a terrible barrier for first home buyers who just can't keep up in terms of saving their deposit. We don't have the level of buyer incentives from state and federal governments that we've had to kick that along. That was a big factor last year. The main thing is higher prices, but we've actually seen quite a modest easing. Numbers are down over 4 consecutive months now, Michael, first home buyer lending, but not really down sharply, down 7% from their peak in January, and this is seasonally adjusted. But I think that firstly shows that there's still some resilience from first home buyers. They're obviously very keen to take advantage of what is a very positive outlook on the market. I think that we haven't seen the sharp fall in first home buyers that perhaps we would have expected, or perhaps a sharper fall.
In fact, your chart here, Andrew, suggests that even though first home buyer loan market share has dropped, it's still above the long-term averages.
Yeah, well, that's right, Michael. And when we look at those proportions, that tells us a picture with more depth that we are starting to see market share for owner-occupiers and first home buyers falling, but it still remains well above average levels. And conversely, we're seeing investor activity as it rises. Its market share is increasing, but still below its long-term average levels. But the investor market really is building up ahead of steam, Michael. One of the reasons, obviously, is it's catching up with those long-term averages. But the point is that it's not crowding out first home buyers to the same degree as perhaps would have been expected. We had a big rise in investor numbers over May, and only really a slight easing in first home buyers. So that still shows you that there's plenty of upside to this market, that although it is adjusting from higher prices, it's a very much a modest adjustment, Michael. And I think one of the really interesting points from the first home buyer data was, even though we saw a decline in first home buyer numbers over May, we saw another rise in the average loan. So although we're seeing fewer first home buyers, they're actually having to pay more for their homes, Michael, and that sort of says it all. In fact, if we look at the state breakdowns for first home buyers, we can see, as usual, Victoria led the charge in terms of the number of first home buyers over May, well ahead of New South Wales in second place. But when we look at the average loan for first home buyers in each of the states, we can see how far ahead New South Wales was from Victoria, well over $500,000. It was interesting that the average loan on a state-by-state basis, Michael, for first home buyers over May was a record in every state except Western Australia. So that tells us, obviously, what we know from other data points, that prices are still rising. There's still plenty of demand in this market, and buyers are still struggling to get the whip hand over sellers. I think if we look at that average loan number data, Michael, as well for investors, I think there's some very interesting points there. We saw the disparity between the average loan for first home buyers in New South Wales, or in the states, for average loans, with New South Wales being ahead. But if we look at the average loan for investors, Michael, on a state-by-state basis, we can see that New South Wales is light years ahead. In fact, nearly $150,000 higher than second place Victoria, which of course represents the high price Sydney market. And investors that don't have the same constraints as first home buyers can pay more for their investment property because, as I said, they don't have the restrictions to borrowing that first home buyers do per se. And therefore, we're seeing a much bigger gap between the average investor home loan and the average first home buyer loan on a comparative basis. So plenty of upside for investors, Michael, not just for the number of investors, but also what they're obviously prepared to pay to get into the marketplace at the moment.
Looking at the other side of the property markets, the rental markets, you did a report for June, the month just gone, and you found that rents are starting to rise now, Andrew.
Yes, look, it's an interesting dynamic. We're seeing an adjustment in the rental market. Vacancy rates are trending downwards just about across the board. Vacancy rates really, even with the markets that we know have been perhaps a little oversupplied, well, not perhaps, they have been, and that's those CBD markets in Melbourne and the inner suburbs in Sydney, we're seeing quite a significant reduction in the number of vacancies in those particular areas. Now, they're still high, make no mistake, but we're certainly seeing a consistent downward trend on a week-by-week basis for the number of properties that are advertised in those areas for rent. And I think one of the factors there is that borders are opening up now, or have been over the last month or so. And of course, that's encouraging Airbnb landlords to move out of the permanent market and back into the temporary market. I think that's helping to ease that. But of course, we are seeing, even though it's early days, fewer first home buyers as well. People are perhaps a little bit more confident about making their rental decisions and are moving back into the marketplace. And obviously, with fewer new rental properties coming into the market, as we've had a dearth of that because of fewer investors and fewer developments over the last 2 or 3 years, that's also having an effect on those particular markets. But it really won't, I guess, get back to a more normalised environment in those inner city CBD markets in Melbourne and Sydney until we get the demand, particularly from students, into those particular areas. But the markets are tight, Michael. We certainly have upward pressure on rents just about across the board, the exceptions being those inner city unit markets. Perhaps some easing of vacancy rates in Melbourne as a response to what we know has been a population shift out of Victoria. But vacancy rates are still quite tight for houses in Melbourne. And I think that we are inevitably reaching the early stages of a shortage of rental properties in our capital cities, which will continue to put upward pressure generally on rents. And the trend for vacancy rates, Michael, is clearly downwards, in other words, tightening just about across the board, even for those markets that have had a very high vacancy rate over the past year.
Andrew, I'd like to finish off on something slightly different, because the media loves comparing property with shares, which is a better investment. And you did a great article a couple of days ago. And sure, the Australian share market finished last financial year on a high. It grew 25.6%.
Yes.
But that's short-term thinking. And of course, you're comparing apples with oranges. Shares have dividends. Properties have rents. You can borrow more against property than shares. But with this chart that we're looking at now, when you look at what's happened since pre-GFC, it's a no-brainer, property versus shares, isn't it?
Well, poor old Australian share market. Yeah, there was a lot of, I guess, backslapping and congratulations from those that like to promote the share market regarding the fact that they'd had such a great financial year, best since whatever. But the whole point is it has been a pretty poor performance overall, and it's coming from what was a terrible decline in shares through lockdown last year, which impacted the 19-20 financial year in terms of share performance. But if we go back and look at what is a benchmark starting point, and I think beginning of the GFC is a good benchmark for us, because we know that world share markets all peaked prior to the GFC at the end of 2007. So we are starting off at a base point that we could rationalise. And we can see there that Australia has been a terrible underperformer, particularly compared to the US, which has actually had a very positive period since the beginning of the GFC in terms of its share market performance. But similarly, we can see that really Melbourne and Sydney house prices have kept track with US shares. And certainly there's a very big difference between the growth in the share market. This isn't just marginal, Michael. It's quite spectacular, the difference. And of course, it does manipulate this comparison depending on what your starting point is. So those with a vested interest can create a nice starting point, which promotes their point. But at the end of the day, as I said, I think we know that Australian shares, and it's interesting to perhaps delve into why Australian shares have underperformed so spectacularly compared to other share markets, not just house prices, over that period of time. And there are factors here, of course. Our higher interest rates were a moderating factor on share market activity through our secondary mining boom, got us out of the GFC, unlike other countries. So you can examine that. But I guess to a mug investor, Michael, when you look at those returns, it really does hit you fair and square in the face, doesn't it?
Very much so. You can't argue with those figures. Now, some people watching this week are going to still be in lockdown. Others are a little bit confused about what's going on. But as we move forward, I think what the figures we've just talked about show is the resilience of our property markets, the depth still in our property markets, and actually the confidence Australians have got in their future, Andrew.
Yes, Michael. And look, perhaps next week we can look at the latest building approval data. And I think that's something that really does examination, because I think that this is one of the factors that will continue to fuel demand ahead of supply, is the fact that we're undersupplying and have undersupplied our housing markets. And I think we'll get another confirmation with the latest data that past the peak of the recent building boom, now the government incentives have ended. And look, at the end of the day, it's just going to mean higher prices and higher rents, Michael. And I think only closed borders have saved us from that happening even sooner.
Well, I look forward to our chat again next week. Thanks, Andrew.
Thank you, Michael.